motel, and I bought a couple apartment buildings. I bought a bunch of duplexes because I thought that was the way to go. It seemed to me, I bought into the plan that there was more cash flow in those types of properties. And what I learned is there's also a lot more work in those types of properties. So I learned that some people will willingly pay rent because they value the property and they want to stay there. Other people are just passing through. And if they're just passing through, if they can beat the landlord out of a nickel, they will.
This episode brought to you by Suites at Madison. Meeting and conference rooms for rent by the hour, week, month, or year. Suites at Madison, where business gets done. Check them out at www.downtowntampaoffice.com. Now, on to the show.
You are listening to the Invest Florida Real Estate Show, covering topics in lending, buy and sell strategies, property management, hot markets, and tips and tools to guide you along the way on your path to real estate success. You want Florida investment real estate talk? You have come to the right place. And now, our hosts, Eric Odom and Steven Silverman.
Hello and welcome to another episode of the Invest Florida Real Estate Show. This is your co-host, Eric Odom, along with Steven Silverman. Steven, very excited about our guest today.
Well, I know there's a long history in there, so I'm looking forward to it also.
Yeah, we've been trying to get him on the show for several years. He's a man of travel, a Renaissance man, and he's around a lot of different places and has a lot of different interests. And very successful real estate investor down in Sarasota. And we're happy we're finally able to get on his schedule. I know part of the episode we're going to be talking a little bit about efficiency and not being penny wise and pound foolish. John's certainly one of those guys that if he can set the table right, he'll actually leave a few nickels on the table to make sure that he's getting the situation right for himself. But on the flip side, you had somebody who came in the office today. And why don't you tell the story about him?
So this was really interesting. It's a guy who owns a shopping center, about 35,000 square feet, and he's struggling with vacancies. So he wants us to lease out the property and to find him tenants and to increase the value. So his strategy was, he said, because of the situation I'm in, I'm going to offer you below market commissions, and I'm only going to limit commission payments based on 2 or 3 years. Yes, I'll take a 5-year tenant, but I'm not going to pay you on that. And we had to explain to them what a terrible strategy that is. Someone like that especially has to get brokers that want to lease out his property. Otherwise,
there's, I think certainly in the retail world, about 2/3 of all deals are still done by brokers. And, if you're basically sending a message to the broker community that they're not important to you, they're going to take that tenant someplace else.
Well, we're brokers ourselves. So, I mean, in a way, it's self-protection. But what you're saying is right. Everybody has to benefit. You have to leave something on the table.
Yeah. Yeah. It's certainly not, obviously it sounds self-serving, but it's really not. We see this type of mistake all the time. Sometimes we'll take those listings and sometimes we won't. Because if we feel like we can lease it on our own without other brokers and we can get the deal done, we'll take that type of a deal. But most of the time not, because we need help from other people. It's a fact.
Well, in this case, we actually explained the fallacy of his ways to him, and he capitulated. We have a normal listing going, and he'll benefit.
Well, yeah, it's great when you actually have those types of stories with the guy that actually can see the light after you have an explanation, because many times you get a blank stare and you shake hands and part ways, friends, but not doing any business. So I'm glad that you guys were able to get that settled. I have, before we get rolling into our guest, I want to get on it pretty quickly, but I'd actually forgot about Robert Doms. Robert, appreciate you left a review actually back December 22nd. Great discussion on real estate investment. We didn't read off your review, but we definitely appreciate the time that you took to write the review. It does help us with guests that come on the show. They do look at our reviews and see who's paying attention and who's listening. All these guys are in it for a reason. Not everybody just wants to chit chat. They're doing business. And so they want to make sure that there is a listener base they can potentially do some business with. So, Robert, when you and other folks leave those types of reviews, it definitely helps us to make the speaker, make the guest feel a little bit better about the time that he's investing with us. Steve, is there anything else before we get rolling on? Oh, I guess we should ask.
And we feel better too when we get a review.
So guys, leave us a review. It makes him very happy. His mother gets very excited when, actually not very many people say anything positive about Stephen, but when they do, she gets really excited. So guys, leave a review, if not for the guest, the quality of the guest, but for Stephen's mother.
Yeah, please. She'll appreciate it.
I'll say, guys, let's, Stephen, anything else before we roll into the show?
Let's roll into it. Today we have with us John Schaub. John has successfully avoided holding a job since graduating with a degree in business from the University of Florida. He has survived and prospered as a full-time single-family landlord and shares what he has learned with students and readers of his books and newsletters. His best-selling book, Building Wealth One House at a Time, has helped more than 100,000 investors begin investing. So John likes making money, but he also likes spending money. He has owned and flown his own plane around the country, and he is an avid skier, sailor, and scuba diver and tennis player. He is an advocate of affordable housing and education and has served for 25 years on the board of Habitat for Humanity in Sarasota. He's also served on the board of International Board of Habitat and chaired the International Board of the Fuller Center for Housing at the State College of Florida College Foundation. John, welcome to the Invest Florida Show.
Thank you. Thanks. Nice to be here.
Yeah, John, we really appreciate you taking the time and talking to us about your career and where the market is right now. But there was a little bit of not completely, a little bit of in terms of your bio, that's a little bit of a change there because I don't know if you remember, probably not, but my dad in Sarasota knew your dad. And my dad actually was controller for Sears, and your dad was obviously very, very well known in the Sarasota area as a manager of Moz Brothers when Sarasota was a sleepy little town. And I believe you actually worked at Sears alongside my dad there for a while, did you not?
Well, yeah, I worked at out of the gas island at Sears when I was into high school and the first couple of years of junior college, I think. So I'm sure we ran into each other on a regular basis.
No, it's funny. I mean, that was back in the days when Sears actually had gas, and that's of course something completely in the past. But how did you end up in this crazy business?
Well, my dad grew up in Florida. He was in Miami back in the 20s and moved to Tampa in the late 20s, and so he saw all these real estate booms and busts, and he always had the real estate bug, even though he was working for a department store all his life. And I kind of caught it from him, I guess. And when I was in college, I managed an apartment building and answered an ad in the paper. They were looking for a manager to a little 6-unit building. So I answered that ad and I managed that. And then a fellow came along one day and wanted to buy it. So I sold it to him. I had my license already. I took courses in college to get my real estate license. And so I made about a $6,000 commission, when I was 20 years old or 21 years old, I guess, to get a license. The guys, my good friends who were getting out of law school were making $6,000 a year. I said, I'm on to something here. This is better than law school. So instead of going to law school, I just jumped right into real estate with both feet. And I've had a lot of different experiences, but I started off as a broker and as a salesman, then a broker, taught a lot of classes early on, CCIM type investment classes and GRI classes for realtors and started in the seminar business back in the mid-'70s where we were teaching people how to make investments. And that's what I'm still doing today. I don't teach often. I teach once or twice a year, but I still think that real estate's a great way to develop a net worth and develop cash flow you can retire on. So I try to show people a good way to do that, without hurting people, a way to help people when you buy and a way to help people when you sell and a way to help people when you rent. We've been in the same town 40 years and the same business 40 years. So referrals are big for us. We don't do any advertising. All our business is referral business. And you don't make people mad and get referrals. So, you just have to make deals that are good for everybody when you make one.
Hey, John, just before we start, you mentioned CCIM. What's your CCIM number?
Oh, I don't have a number. I never got my ticket because you had to do case studies. And I didn't have any clients. I only owned property in my own account, so they wouldn't let me use my own property as a case study. So I never got the ticket.
Just shows you how crazy some of these things get. So
the world changed a lot. Back when we first started teaching about investing in houses, there wasn't anybody talking about that. There were a couple of guys who had written some books back in the 60s, but very few people saw houses, single-family houses, as an investment. And I didn't when I first started. I started out selling land with my license, working for a developer, and then I bought a motel and I bought a couple apartment buildings. I bought a bunch of duplexes. Because I thought that was the way to go. It seemed to me, I bought into the plan that there was more cash flow in those types of properties. And what I learned is there's also a lot more work in those types of properties. I can still remember my first 9-unit building. I went over and knocked on the door one day to collect the rent, and I got the first person to pay me a rent, but nobody else would answer their door. So they all looked out the window and saw me standing out. So I had to go back 9 times to sneak up on 9 different people to collect rent, and that's a lot of work. So I learned that some people will willingly pay rent because they value the property and they want to stay there. Other people are just passing through. And if they're just passing through, if they can beat the landlord out of a nickel, they will. And I didn't want to deal with that type of person. It's just too much work, and it just didn't suit my personality. So we started buying better properties. We kind of fell into the house business by accident. I bought my first house in 1973, and I still have it. And, we bought it from a guy who wanted to sell it, and he financed it for us. And, it was an easy house to manage because I rented to somebody and they stayed there 10 years. And then didn't take me long to figure out if somebody would stay and not move out every 6 months like they did in the apartment building business, that I'd do a lot less work. So we transitioned from we had some commercial property too. We transitioned from the commercial property and from the land and from the apartment buildings and the motel and all the things that took a lot of time to manage into a portfolio of houses, which take a far less time to manage because the people stay longer. It's just that simple. If you can keep a tenant in a building 5 or 10 years, you work a lot less as a landlord than you do if you have somebody move out every 6 months or every year. So our average tenant stays about 10 years now because they like where they live. And, we buy in areas that have some appreciation. We're lucky enough to be in Florida, people moving into Florida. We're in a town in Florida that's growing. So if you're in an area where population is increasing, there's generally a shortage of housing, which means rents go up and prices go up. So all that works together, and it made my returns on people ask me why I stay in the house business instead of getting into something else. And I say because I make more money in the house business and it's a lot less work. So those two things combined keep me right where I am.
It's so interesting because we've spoken to people who they look at houses as a stepping stone to get to multifamily and then commercial because they figure the work decreases as they progress. So it's refreshing to hear your point of view.
Well, if you have a big enough unit, I have a good friend, I'm not even going to tell you his name, but he owns a couple thousand units of apartments, and he doesn't do much work because he pays people to do work for him. But you have to have quite a bit of volume in order to hire a manager that has a strong enough skill set to do a great job. And if you only own a couple dozen units, you can't afford to hire and pay somebody much money. And if you pay somebody a nominal commission like 5 or 6%, there's not enough incentive for those people to take a day off of playing golf and go out and rent your place. They'll go play golf instead because there's just not that much money involved in the deal. So we a couple of things. We manage our own properties. And by doing that, we cut out the middleman. We don't have to pay a manager. And because I manage my own properties and my tenants know that I own them and I'm the operator, they respond to me better. We are responsible landlords. We fix things when they break. I had somebody call me this morning or email me. We don't take calls. We do everything email. But they told me about a problem, and by noon I had a fix. So, if you can give your tenants good responses, if you can take care of your tenants and manage your properties well and maintain them well and be proud of your properties, then your tenants will be proud of your properties, and they'll take care of them, and they'll value living there, and they'll value having you as a landlord, so they pay the rent on time. And that's a whole different game.
Now, John, do you only own in Sarasota or the Sarasota area, or do you outside of Sarasota as well?
Well, at one time I owned property in 10 states. I had a good friend. His name was Warren Harding, and he had a group of people together called the Academy of Real Estate, and he gave people a big plaque if you could own property in 10 states and document you had $1 million net worth. And so I did all that back in the 70s. And I've got that plaque hanging on my wall. It'd have been far cheaper just to buy a plaque. Because when you buy a property in 10 states, you don't make money on all those properties. Some of them are losers. But I learned a lot from that experience because I own property. I bought property in partnership with people that I knew in these states. I just didn't go out blindly and buy things. But even when you have a partner in a state that's far away, you don't make as much money as you do if you manage it yourself and you stay fairly close to home. So I've always taken the approach that there's enough real estate in my town that I don't need to own it all. I just need to own my piece of it. And there's plenty of opportunity in my town. So going further away from where I live does not improve my profits, and it really makes it more work because now when something goes wrong, I better go fix it, and I have to go someplace to fix it. So having things fairly close to where you live, I think, is a better strategy than having things all over the country. Now,
I seem to recall when there was a seminar that I went to yours, and this is 25 years ago, but you were talking about, and I don't know if you remember the conversation, but California, there was an area in California that you thought was very comparable to Sarasota, but it was just ahead of the curve. Was it Santa Barbara or something? Do you recall anything about that?
I don't remember 25 years ago what I said, but I mean, there are a lot of areas. California is like Florida. It's a big place. So there's a whole bunch of different sized towns and with different growth curves. And, some of the hottest real estate is in California, the San Francisco area and the Bay Area and down in Orange County and San Diego. But if you go inland a little bit and go away from the coast, they have some very comparable towns. The prices are comparable to ours right now, and actually, I think Florida has more appreciation than most of those towns do in California. But you don't chase a hot market. It's a mistake, I think, to say, okay, which market's the hottest? Let's go buy there, because it's probably been hot for a while, and you're getting in at the end of that market. You're better off staying close to home, I think, where you have good information, values. And even if you pay a little bit too much, if it's close to home, it's pretty easy to manage, so you can hold on to it for a while until you have a profit. If you buy something far away, then you're under pressure to sell it sometimes because either your manager quits or you're not making money or you just don't know much about the market. We had a property up in Boston, which is one of the best markets in the country. And a guy made us an offer, and we took it, and we found out later that it was worth a lot more than we sold it for because we just didn't know. We had advice, we had people check on it, but we still didn't know. So owning stuff close to home is my strategy. And, in my business, it depends on how big you want to get. But most people don't need to own hundreds and hundreds of properties. They just need maybe 5 or 10 is plenty for most people. So, if your goal is to have a couple $1 million, that's not that many houses at $250,000 a piece. That's just 8. So you have to keep things in perspective. And sometimes people set goals based on just a number. And I at one time had a goal of owning 100 properties, and I got up about 2/3 of that, and I said, "Now, why do I have that goal?" Because I was working a lot. So we reset our goals to have fewer properties, same amount of money, but fewer properties and more cash flow. And so be careful how you set your goals.
So John, you suggest to invest where home is, and your home is Sarasota. What's going on in the Sarasota market?
Yeah, where
do you see it going?
Yeah.
Well, the whole west coast of Florida, the whole state of Florida, probably. And, Florida's a big place, so there are some pockets that are different. But the coastal cities seem to be in a real boom period again right now. We have a shortage of houses. Average time on the market's only a couple months, and prices are going up. But they're still not as hot as some places. I mean, the Denver market, there's other markets that are far hotter than Sarasota or anything in Florida. So we have a lot of upside potential yet. As Florida grows, the government gets more involved in regulating land development, regulating building, and we've had some more stringent building codes, and the development codes are tougher. It just makes it more expensive to build properties, so the existing properties benefit from that. And we've seen our average appreciation has probably been 6 or 7% for the last 25, 30 years. And it depends on where you own it. And I know there's some smaller towns, the middle of the state probably don't have that kind of growth, but a lot of places on the coast have at least that much growth, I think. And I think it's going to continue. I think people will keep moving here. I don't see any reason, unless it quits snowing up north, I don't see any reason they won't keep coming.
With that in mind, John, what are some of the specs, the bogeys that you want when you're making to hit when you're purchasing a home? Like, do you look at it, you want to buy, at X% of market value? Is it a cash flow that you look at? Or what are some of the specs that you want to hit, the bogeys you want to hit when you're making purchase decision?
And maybe with that answer, John, you can also cover who, in your opinion, is the target customer in order for you to make that investment work?
You mean the tenant, Stephen?
Target tenant.
Okay.
Well, and that's a good question, because you really should work it backwards. You should ask the question, who do I want to rent this house to before you buy it? When I first started buying houses, I bought a lot of inexpensive houses, and the people that rent inexpensive houses are not your best tenants. But if you go to the other end of the spectrum and buy expensive houses, the people that rent expensive houses are not great tenants either, So there's a group in the middle someplace where people actually work and they want to live in a decent house, but they can't afford to buy that decent house yet. There's that area in the middle, the mid-price ranges that's kind of gold for me. And when you first start out, you buy less expensive properties. You do that because the cash flow is a little bit better. You can get more cash flow from a $150,000 house than you can a $300,000 house. But as you get wiser and you develop better skills and you're a little more patient, then you might say, well, that $300,000 house is a better opportunity for me now, because I can buy a $300,000 house further below the market than I can a $150,000 house. You follow my logic.
Yeah.
And then you can move right up to scale. But what happens, of course, is you move up to scale to a $500,000 house or a $1 million house. The amount of cash flow return you get on your investment goes way down. So you have to buy it further below the market. But in these downturns that we have, I'll tell you a story. I can't give you too many details, but there was a house here. I'm just going to use round numbers. That was for sale for $1 million, and they tried to sell it to me, and I offered them about half that much money. And we got really close to buying that house for about half of what it was worth. And it was really $1 million house in a $1 million neighborhood. It was solid. It's just there wasn't any market for it that day. It was really a slow market. So you can buy things at terrific discounts sometimes if you're patient. And, you're trying to target them. And once you figure out from a income tax standpoint that it's better to make capital gains than it is to have more ordinary income, then you try to arrange your investment strategy so that you have more in capital gains over the long run than you do ordinary income. You'll have a balance of both, because if you have a property that you're renting, you have ordinary income from the rents. But if you buy that property at a little higher price property and you buy it at a bigger discount, that discount, let's say you buy a $300,000 house for $250,000, that $50,000 discount will be taxed as a capital gain if you hold on to it for a long enough period of time. So that our strategy is typically to buy something and hold it until it at least doubles in value, because we want that capital gain. That's more important to us than the cash flow. Now,
just to sort of make sure I understand properly, you're buying at a discount, and that has a built-in capital gain with it already, because you're buying it from somebody who's not patient, and you're going to be patient when you sell it, so you've already got a built-in capital gain.
Yeah, I'm buying from somebody who's just ready to sell, and then those people are ready to sell for a lot of different reasons. Most of the time, I tell brokers I buy about half my properties through brokers, and I tell the brokers if the house is empty and the people are anxious to sell, bring me the house and I'll make you an offer. I don't care what the house looks like, I'll make you an offer. And I buy a lot of houses like that, because there's a point in time where people just snap and they say, okay, we've had enough. Let's just get rid of this thing. Next offer we're going to take. And, if the broker knows that I buy things, they'll call me up because they know I'll buy and we'll close it in a couple of days and everybody will be happy. Sometimes it's more important for people to get their money faster than it is for them to wait for a profit. I'll give you an example. I had an attorney here in town who got a job offer in another town, but they wanted him there right away. Well, he had to pack up and leave that day, and he called me up and sold me that house that day because the house wasn't important to him. He gave away a bunch of money because he didn't want to sit around and try to sell that house for the next 6 months. He wanted to take that job because it paid him a lot more. And you can understand his motivation. So people move for job purposes. People move because their family's outgrown the house, or their family is now not big enough for the house. There's a lot of different reasons people sell. And, people die and their property ends up in the estates. And the estates typically are great people to buy from because they inherited the property. They don't have any money of their own in there. And they again, most of the time are interested in getting their money in a hurry rather than waiting 6 months or a year for a high price.
So what's the worst discount that you'll take in order to buy a property?
Is that 10%, 5%?
Building wealth one house at a time. I have a little formula I lay out, and I explain to people that they should think this way, that they should think to buy something at least 10% under the market, with no more than 10% down, and they shouldn't pay any more than 10% interest. Well, 10% interest sounds really high right now, but it may not sound really high in another 2 or 3 years the way we're going. I've been in the markets where we bought in 1981. I bought 16 houses, and the average interest rate was 14%.
Ouch.
But we made money on every one of those houses. The bank didn't want them. The guy who owned them, the builder, he didn't want them. Everybody, they were just giving houses away back then. But you had to be able to carry them, and we rented them right away, and we had to feed them for a little while, but we were buying things 30 and 40% below the market, so you can afford to feed them for a little while. So to answer your question, probably the minimum is about 10% below the market, just because you don't know exactly what the market is, and you're saying a house is worth between maybe 2 and 225. So if you can buy it 10% below that too, you're pretty safe. There's a really good chance you're going to make money on that house.
And how are you finding those deals that are 10% below the market? Is it mostly through your own efforts of mail? You're going through brokers, or how's that working?
Well, I said it before, but I buy about half of my property through brokers, and that's depends on the cycle we're in. When it's really easy to sell a house, they don't need me. When it's hard to sell a house, I get a lot of calls. So it depends a little bit on the point in the market we're at. Right now, it's fairly easy to sell a house, but still there's opportunity. I have a lot of students, and we go skiing. I've got a group that goes skiing every year. It's my mastermind group, and one of our students in that group bought 26 houses last year, and every one of them was a good deal, and every one of them was owner financing, and they're all in his town. Here in Florida. So there's if you go out and work at it and talk to enough people, you will find deals. There's always a deal out there. If you're in a town of 1 million people, somebody in that town wants to sell that house that day. You just have to find that person. And all those things you talked about, direct mail works. I don't do any direct mail at this point in my life because I'm not trying to do that kind of volume. We buy typically 2 or 3 properties a year. And I don't need to do a direct mail program to buy 3 properties a year. Now, my students that buy 50 properties a year use direct mail and are aggressive with it, but, they send out 10,000 pieces a month, and that costs a lot of money. You've got to have, you really have to have a business operation to do that, and you have to have people going out and looking at these houses and making offers on a regular basis and have a business plan to buy a lot of properties. And that's not my game. My game is to buy slower, to buy fewer properties, not work quite so hard, but then to hold on to them. And we use the cash flow off the properties that we already own, sometimes to fund a new property. If we buy something today with a very low down payment that has a lot of debt on it, it won't make any money for a few years, but we can afford to carry that because we have other properties that do make money.
So just to clarify for me, I thought when you said one of the things you offered were you'd close fast, I thought you were going to say that you go in with cash offers, and then you actually said that your golden rule is 10% down. How do you get those properties to finance? Is it seller financing, or what's your approach when you hone in on a deal?
Well, I said that the advice I give people in the book is never to pay more. These are kind of just guidelines for people getting started in the business to try to buy at least 10% below the market, try not to put any more than 10% down, and try to pay less than 10% interest. If you do those 3 things, if you buy a house today at 10% below the market with 10% down and pay 10% interest or less, it probably won't quite break even. But you can get a deal today with less and pay less than 10% interest. There's people who will finance properties for you 4, 5, 6, 7, 8% right now. So you can do a little bit better than that. So you may end up paying a little bit more because of that. But I'm always, every deal is different. You know that. Every deal you look at is different. People have different motivations. Sometimes you can buy a house with high leverage and people will finance it for you. Sometimes it's an all cash deal because they'll discount it if you pay all cash. So, you have to be open to different possibilities. When you're first starting, if you don't have a lot of money, that sort of limits your possibilities. The first house I bought, I didn't have any money, so I bought it. I borrowed the money for the down payment, and ended up giving half the property away to somebody else, put up the down payment, and we split the profits on it. But it's a good deal, and you make the deal you can make that day. But I don't go to banks. When I first started in the business, the banks were not my friends. They weren't going to lend me money because I was a young real estate salesman, and I was doing okay, but I wasn't doing okay for a long enough period of time that the banks liked me yet. So when I first started buying property, every property I bought was owner financing, and I learned you could do that. So throughout time, I've used either owner financing or my money or investor money or anybody's money but the bank. Because the simple reason I don't use banks is it just takes them too long to close a loan. If you want to use a line of credit, then you can get the money the same day. But if you go down there and say, I've got a contract to buy this house, we want to close tomorrow, it's pretty hard to get a bank to close a loan in one day.
Yeah. And also with a line of credit, I mean, a lot of investors that own 2 to 3 houses aren't going to be able to have a $500,000 line of credit to be able to buy. So I can understand the point that it's not really necessarily a viable option. But you're going out and finding these people that might lend. How do you talk to your investors, your students about finding folks that would lend them the money outside? Obviously, the first and foremost is the owner financing, but the other sources besides owner financing, how would you recommend them finding those folks?
Well, you're looking for somebody who needs to invest. If you there's hard money lenders out there who are in business, or they may be private investors, but they see themselves as in business of lending people money, and they charge higher rates. They charge 12, 14% today. When if you had really good credit, you could go down to the bank and get a loan for 6% probably, or 5%. So you end up paying a real premium to people who are in business if you borrow money from mortgage brokers or people in the business. But there's a lot of folks that have money sitting in the bank right now. I've got money in the bank. I assume you guys have some money in the bank. The banks don't pay much. They're paying 0.6% or 0.4%. Right. If you buy a CD, 1.2% or something like that. So the rates of return that people are making on their money in banks is pretty low. Some people are more sophisticated. They get in the stock market, or they get in the bond market, and they get some higher yields, but they take some risk to do that. But if you find somebody who has money and they want a safe investment, and they have it sitting in the bank at 1%, and you can pay them 5% or 6%, they're going to be happy because they've increased their income by 5 or 6 times. And if you give them the collateral of a first mortgage on a house that's in a good area that you're going to manage, and they can go look at it and see that it's safe, and you've made a good deal on it, you bought it below the market, that's a pretty safe investment for them. And it depends a little bit on your management skills. But I can tell you that every deal I've ever put together with an investor has gone well because I've made it gone well. I've lost money on some of those deals, but I've never had an investor lose money because that's the way you build your reputation. You take care of people. If somebody puts up money for you to buy a house, you make sure they get that money back and they get their profit back. So I won't say some people think it's safer than going to a bank, but it's really not because your reputation's on the line. And you probably shouldn't go to an investor and borrow money from an investor to buy a house until you've bought a couple without investors. You should know that you know what you're doing, that you can buy something in a good area at a good price, you can rent it, you know how to manage it. So develop some skills before you go out and borrow money from somebody, because you've heard stories, and there are a lot of stories out there between friends who either lend money or family members who lend money, and the deal goes bad, and that's a very sad situation. So don't make that happen. Make sure it's going to go right.
So one of the things you mentioned is that your tenants stay for a long time. So what are the skill sets, or what are the things one should do to keep tenants? Maybe you can give us 3 pointers that
a rookie landlord might make a mistake in treating those tenants. That he's every time you turn that property over, it's expensive. I know that, and you're keeping tenants for 10 years. That's what you want to do. So what
my average expense?
Yeah, what's 2 or 3 points that rookie landlord they might want to know? They might make those mistakes that you've learned over the years.
Well, the mistake most rookie landlords make, I think, is they rent the house to the first person who says, "I'll take it." They don't know that they can qualify people, and so they don't qualify people. They're so excited to find somebody to move into that house that will actually promise to pay them rent that they say yes the first time somebody offers to rent their house. Before you rent a house, you should have some idea, and you should actually write this down. You should know exactly what qualifications you want in a tenant. What range of income they should have. And beyond the income, you should look at their debt. If somebody has 2 car payments and they're paying alimony or child support, they'd have to make an awful lot of money to qualify to be a tenant. So you're looking for somebody who has enough net income after their expenses to afford to rent your house. And, the rule of thumb is you want somebody that's making at least 3 times what your rent is. And that's still a rule of thumb because, again, you want to look at their debt and you want to see what kind of job they have. You have people show up sometimes and say, well, we make a lot of money. And you say, how? And they say, well, we sell stuff. We're a salesman. I said, well, you better show me a couple of years tax return, show me that you were a good salesman, because some people just started selling yesterday, they haven't sold one yet, and they never do sell one. So people will tell you stories to get into your houses. So, but let me back up a little bit, give you the backstory. The backstory is you want to buy a house in a neighborhood and on a street that will attract a good tenant. And a good tenant, somebody who will pay extra for a good house. If you buy houses, I made this mistake. I bought houses on busy streets. I bought houses on corners that had a lot of traffic. I bought those houses because they were cheap. But then I found I had a really hard time attracting good tenants because a good tenant has his choice of properties, the choice of their property. So if somebody's got a couple kids and a dog, they don't want to live on a busy street. They don't want to live on a corner lot. They want a backyard. They want some privacy. They don't want noise. So in the class, in my class where I teach once a year here in Sarasota, we actually go out in the neighborhoods and walk through these neighborhoods and look at these houses and talk to people that have houses for sale, because I want people to have that hands-on experience and kind of feel it, kind of smell the air and hear the noises and listen to the dogs bark and understand this is a real world. This is not some computer game, and you're dealing with real people. And the tenants you're going to get are going to look probably a lot like everybody else who lives on that street. They're going to drive the same kind of cars, have the same kind of jobs. So, if you're nervous about that street, don't buy there. Buy someplace that you feel comfortable. And my rule of thumb is I'd never buy a house that I wouldn't move into myself. If I wouldn't live in that house and feel comfortable with my family in that house, I wouldn't buy it. So that kind of gets you in the right neighborhood and helps you buy the right house. Now, the right house to me is a house that's big enough and in good enough shape that people will move in and stay there for a long time. People move back out because the house is in bad shape or there's something wrong with it or the neighbors are bad. So another reason to get out there and spend a little time in that neighborhood, because if you have a bad neighbor, that's hard to fix. So you want to make sure that you walk around the house, you meet the neighbors, you talk to people, and make sure it's the right place. And I always put a little pressure on myself when I buy a house. I go across the street and I talk to the neighbor and I say, I'm buying a house across the street. And they say, great. And when are you moving in? I said, well, we're not going to move in. We're going to rent the house. And they say, well, that's not so good. And I say, well, let me give you my name and phone number, because if I rent a house to somebody and they ever cause you any kind of trouble, I want you to get a hold of me right away and I'll fix the trouble. And that puts pressure on me to put the right people in that house, people that fit in the neighborhood and will behave and take care, keep their pets and their kids under control and just do the right things. And that's all we ask. We just ask people to do the right things. By doing that, you end up with people who want to stay in that house for a while. And, my longest term tenant's been with me 28 years now.
Oh my gosh.
They paid for that house more than once. I had a 20-year loan on it, and they paid it off. They moved in when the house was almost brand new. So it's interesting to see what people will do. And the reason they continue to rent is they don't want the responsibility of owning a house. They are very clear about it. So people have different needs and different wants. And so not everybody wants to own a house. And only about half the people do own a house. So the other half are tenants.
Can I ask you about that tenant that's been with you for 28 years? Have they followed the market rents, or because they've been long-term tenant, you've giving them discounts off of market rent?
They get a discount off of market rent. Everybody that rents from me gets a discount off of market rent, because remember what I said when we first started. The cash flow is not as important to me as a capital gain. But I don't let my tenants get way behind. So these people are probably 10 to 15% below market. But they've been there a long time. They've made me a lot of money. And so I have raised the rent every year. I just don't raise it a lot. So they're a little bit behind. When they move out, they are paying, I can look up what they're paying, but the rent will probably go up $300-400 a month when they move out. So that's what I'm giving up on that particular house. And across the board, we've been doing it long enough that we don't have much debt anymore. We paid off a lot of our loans. So when you get in a position where you have all the cash flow you need, you do get a little bit lazier about raising rents. And I teach a particular class on that, on how not to get too lazy. We have a class on retirement investing, and it's really titled How to Retire Sooner with More. But you have to stay on top of these things and pay attention. But to answer your question, they are below the market, but not way below the market.
So, John, a lot of people who invest in houses, they focus on looking for houses that they can fix up and improve. The sense I'm getting from you is you'd rather buy a house in good condition and try to get the discount. But what's your philosophy or thoughts on the fixer-up strategy?
Well, I'm not good at it, so I don't do it. And there's a lot of people that have good skills they have good taste and good skills. They can look at a house and see they need to do these things to it to make it better. But it takes money to do that. So even if you buy a house with a small down payment, if you go in there and do a rehab, you could easily spend, depends on the house, $10, $20, $30, $40, $50,000 on that house, and it may take you 3, 4, 5, 6 months to do it. That's not my program. I like to buy a house that's in good condition. In fact, I bought probably maybe 25 or 30 brand new houses, never been lived in. Those houses are not exactly ready to rent because you've got to put drapes up or blinds. You've got to do some things to those houses before you can rent them. But then you've got a house that's in pretty nice shape. It is brand new. Got new windows, new plumbing, new carpet, everything else in pretty good shape. And I'd rather buy a house like that. The last couple of houses I bought have been totally rehabbed by somebody else. I didn't touch them. I bought them from the person that did a rehab. So if you can buy a house that's in good shape, and what you avoid is your downtime, and you avoid putting more cash into the deal, and you avoid surprises. I tell people when you rehab, you should write down the amount of money you think you're going to spend and the amount of time that you think you're going to take to do the rehab, and then double both of them.
No kidding.
Most of the time you go in and you think it's going to cost you $15,000, it's going to cost you $30,000, and you think you're going to do it in 3 months, it takes you 6 months.
Isn't that the truth, John?
Have that perspective, because otherwise you just run out of money and you run out of time, and a lot of people don't come out the other side of those deals. They don't make any money.
Yeah. Yeah. How many times do we look at a project? Well, me anyway. I look at a project at one of my own properties and go, "Oh, that'll take me the weekend. I'll be able to do that." And then 2 weeks later, I'm still banging away on that. I was like, and cussing myself for taking on the project.
That's right. That's right.
So let me ask you a question about, 2008 was pretty tough on a lot of people, and we're still seeing a lot of people with credit challenges. Are you seeing that too? And if so, how are you dealing with a tenant pool that has some dings, and fairly recently within the last 7 to 8 years?
Yeah, well, I look at, probably a lot of my tenants have some kind of credit issue. I'd say, I don't know the percentage, but let's say half. It's important to me to find out what caused that credit issue. If it's an illness and they are in the hospital and they have a $300,000 bill and they're paying it off a little bit at a time, I understand that. If they had a divorce or they lost their business or they had a short sale on their house or foreclosure on their house, they may be in better shape now than they were a year ago. They don't have payments to make. So you look for the cause of the bad credit. If somebody has bad credit, I even think that there's some positives to it. If somebody does have a foreclosure on their record, say 2 or 3 years ago, it probably going to be a few more years before they buy another house, if they ever buy another house. They may be mad enough at real estate that they just won't buy anymore. They just rent for the rest of their lives. So you use some common sense. Now, somebody's been evicted, somebody doesn't pay their credit card bills, somebody, just had 3 jobs in 3 years, then you say, no, that's not going to work for me, because you don't have a track history here of getting back out of this hole. You're just going to stay in this hole. So I'm looking for somebody who is not a chronic abuser of credit, but if they've had a one-time deal or even a 2-time problem, and I understand the cause of the problem, and I see that they're doing better now. Either their business is doing better, or they have a different job and are doing better, or they have a new marriage, or whatever the problem was. I'll rent to them. I take chances on people, and not all my people stay 10 years. That's just my average. I do have people move out after a couple of years sometimes, but we do our best to select folks who have long-term potential going in. And that's really the key. I think you asked a question about how do you keep them in there. That's not the right question. The question is, how do you get the right people in there to start with? And if you select properly and you get the right people in there to start with, the chances of them staying long term are better.
So, can you speak to a little bit about creative ways to finance properties? Are you still finding in this market that sellers will actually finance, or what kinds of things are you telling your students regarding that?
Yep, sellers actually advertise that they will finance. I had a house I'm looking at over here, not too far from my office, where the lady's advertised in MLS that she'll carry back a note of 4%. People who own real estate and they're either in the business or they inherited it or they don't need the cash out of it, ask themselves this question: if I sell it and put the cash in the bank, How much money will I get each month? And if I sell it and finance it, now not everybody has this thought, but you can plant that thought in people's minds. If they sell it and finance it, and you can pay them 4 or 5% interest, they'll have a lot more money. Their money's going to last longer. If let's say it's $100,000, and then people are going to get $1,000 a month. Well, if I will pay you $1,000 a month or plus 5% interest on that $100,000, your $100,000 will last a lot longer at 5%. And $1,000 a month than it will be at 0.6% and $1,000 a month. It's going to run out faster. So how long do you want your money to last is a good question to ask people. There's I had a friend write a book back in 1960s called 101 Ways to Buy a House with Nothing Down. This was before Bob Allen was he was still in kindergarten.
Well, I was going to say, Bob Allen's like Bob Allen personally, right?
Well, Bob took our class. Yeah, he took a class twice back in the 70s. So I've known him for a long time. There's literally hundreds of ways to buy a house creatively. But you don't need to know 100 ways. And that's the mistake some people make. They say, well, we need to find like 20 different ways to do this. And the answer is, no, you don't need, you just need one way to do it. And if you find the right people, if you find somebody who truly wants to sell their house today, you can make them almost any kind of offer, and they're going to say yes. So the question is, what's the best offer for you today? What can you afford? What kind of down payment can you afford? What kind of monthly payments can you afford? How much will this house rent for? And what kind of cash flow will we have if we buy it with $10,000 down? And you need to do all that math before you make an offer. People get real excited when somebody is anxious to sell a house, and sometimes they pay too much, and sometimes they pay too much a month. So if you be thoughtful and back up and write down the offer that's best for you. Don't worry about what's best for the seller. Make the offer best for you, and then see how the seller reacts to it. You will find you get surprised sometimes. When I make offers, to give you an example, when I make offers to the banks that have notes on properties and they're in foreclosure and they're having a hard time getting rid of them, I write down the lowest number that I think they'll take, and then I take another 20% off of that, and that's the offer I make. And sometimes they say, okay,
Wow.
That's 20% more than I wanted, and I take it anyway. So you need to make offers that are good for you and let people react to them, because you just never know how people are going to react. And you're not coercing people into selling. You're simply making them an offer. If they want to sell, they'll either make a counter offer, they'll accept it. If they don't want to sell, they'll say no. I mean, you don't twist their arm. You're just trying to help them out. So people are flattered, and you should be flattered if somebody makes you an offer. That means they like your house. So when you make an offer to somebody, it doesn't have to be the offer of their dreams. It needs to be the offer of your dreams, and then you take it from there. Yeah,
don't feel bad that you swing and miss, because there's going to be lots of swing and misses before you actually get a hit.
No, and just smile when you do it. This is not, if you don't buy a house today, there's another one tomorrow. And, people get all excited about one house sometimes. I see this all the time. I have friends that I help buy houses sometimes, and they'll come to me and they're just all excited. This is the house they have to have. And I said, no, it's not. There's lots of houses out there. And if you don't get this one, there's another one just as good. You might even find it cheaper. So I really encourage people to look at least 2 houses at all times, at least 2 houses. Because if you just look at one and you get all excited about it, you're going to pay too much for it most of the time. But if you have 2, then it kind of gives you a perspective, and you can say, well, this house may be a little bit cheaper, but that house is a lot nicer. It's going to take a lot less work. I can rent it right away, and you start comparing 2 things, and you'll make a more rational decision. It's hard to be rational. It really is. We all think we're totally rational with money and making offers and accepting offers, but we're not. We're emotional people. So you got to bring yourself back down and make rational decisions, as rational as you can make them anyway.
So, John, what was wonderful about talking to you is there's that long history of doing it for so long and seeing what works. If people want to get in touch with you, how can they reach you? Yeah,
not just that, but listen, you've been in this business for a long, long time. And where are you in the cycle right now yourself? I mean, what are you looking for? You say you got money in the bank. Are you looking to still do deals with people or loan to people? Or are you still buying houses? Or are you just sitting tight?
No, we do it all. We do it all. We're in the business. I like the business. I like making deals. I like renting houses to people. I like buying and selling houses. I like the whole work. So, we're not as aggressive as it used to be because I've met all my financial goals a long time ago. So I'm not doing it to make more money, but I like making deals, and I'm always looking for opportunity. We keep money in the bank because, you never know when the next downturn is going to hit. Yeah. Nobody predicted the last one, right? Everybody claims they did now, but I guarantee you, I didn't. I bought a house right before it happened, so I can't see it coming. You never know what's going to happen next. So I keep money in the bank because when we do have downturns, when we do have recessions, there's terrific opportunity. We buy things for big discounts then. So that's when we buy most of our properties and we make most of our deals. So today, to answer your question specifically, I'm not buying aggressively today because the market's had a nice run up now. So we're a little bit on the sidelines looking for the next deal, but we've bought 2 houses in the last 2 years. So, we're always looking. And when we find a deal, we buy it.
And so if somebody's got a smoking deal for you, they either want to sell to you outright or a partner or whatever, how would they go about reaching you?
Well, the best way to reach me is I'll give you 2 things. First of all, so they can qualify it as a smoking deal, they should read my book first. That sounds a little self-promoting, but then they'll know what I think about when they, a lot of people think they have a good deal, but they don't. And I don't want to talk to 300 people next week about deals they think are good. So
let's give your book and how they can get that.
Yeah. Book is Building Wealth One House at a Time. It's on Amazon. It's in all the bookstores. Building Wealth One House at a Time. John Schaub's the name. And you can contact me through my website, which is johnschaub.com, JOHNSCHAUB.com. Go to the contact section and send me a little note, and I'll get back to you as soon as I can. Now, I'm not here all the time. I travel a lot, so I'm in town probably half the time. I've got a daughter in Australia. We spent about a third of the year down there, and I've got kids scattered around. So, we do things other than come to the office every day. But if you'll send me an email, I can respond to that easier. Don't try to call me on the telephone. It's hard to do. But emails are easy to respond to.
Awesome.
I can do it. Whatever time zone I'm in, I can still write you back.
Well, John, thank you for spending time with us today. Our guests will contact you, and
But only with a good deal.
Yeah.
Only with a good deal.
Only with a deal.
John, well, just to clarify things, I only buy deals in my town. I only fund deals in my town. So if it's not in Sarasota, there's no reason to even try to approach me with a deal. But, I'll help you put a deal together. I like that. I like to see other people make money. I like to have rich friends. I've had people do some pretty remarkable things for me, and that's a lot of fun. So, Derek and Stephen, it's been fun, and let's do it again sometime.
I appreciate it, John. You have a good day. Stephen, that was John Schaub. We have been trying to get John on the show for several years. Of course, John, there's a relationship there. Not really. Of course, my dad and his dad, unfortunately, both have passed.
That's an amazing story, the coincidence.
It is. But I mean, I've followed him. My dad took me to that seminar that he did years ago, and I've always followed him. I owned some of John's. It was actually, I'm going to date myself here, but it was CDs, CD-ROMs. And so I own probably 2 or 3 sets of John's CD-ROMs and talking everything from options to buying house one at a time. I've got all those things. And so I've been following him for a long time. Excited to be able to really have a personal conversation with him. I've known him for a long time since I was a kid, but not really that personally. So, Stephen, what were your thoughts about John's discussion with us?
I was impressed by his, I guess I'd call it a disciplined philosophy, but, he's willing to sacrifice cash flow and rent properties at 10 to 15% below the market and rather get good tenants that will stay for a long time and then benefit from the capital gains.
But yeah, that's very different than a lot of other strategy folks that we have on here that are trying to scrape as much cash flow off the table as possible. And John, he wants to buy right? He wants to buy 10% or more below market, and then he's going to sit and wait. He'd rather sacrifice a few months of rent or even a little bit of time of rent to find the right tenant and then give that right tenant a really good deal. So if he's in competition with other landlords, he gets that good tenant and they select him.
You know, and Eric, we've all been through that. I mean, how many times, it doesn't matter whether it's multifamily or office or retail, tenant or industrial, a tenant comes along and you need to rent the space. You have to get the cash flow going, and you kind of feel a little uneasy about the tenant, but you've got someone there. And so a lease is signed, and then somewhere down the road, something goes wrong. And so the quality of the tenant is everything to an investment.
Well, see, and that's the point that I think John was making. If you select somebody who's going to be gone in 18 months or 6 months, every time that house turns over, that's a significant cost. When you're having to transition tenants, particularly bad tenants, all you landlords out there know this. You have a bad tenant, they're more apt to leave that space in worse condition than they found it, significantly worse. And there's a cost to turning that space back around and getting it back in good condition. And so John wants to avoid that. He wants those tenants that are going to be in there for a long time, and he's going to pay them a little bit less. But in order to pay them or to collect a little bit less in rent, in order to collect a little bit less in rent, he's got to buy at 10% or more below the market. So he's just patient. It's just a strategy, and it's obviously served him very well. He's an extraordinarily successful investor. You know, we talk about Bob Allen being in his class. I mean, there's a list of guys who make a living out of talking about real estate. John makes a living out of doing, but he taught a lot of these guys the X's and O's, blocking and tackling of the real estate game.
Well, guys, listen, it's come to the end of the show, but don't forget, there's many more podcasts and information that you can go on our website, and also listen while you're mobile on your bicycle or in the car. Just download the apps from.
And how do they get that? Remembering the website.
Yeah, it's investfloridashow.com.
www.investfloridashow.com.
But also just download from iTunes or from Google.
Awesome. Guys, as always, we appreciate the time that you invest with us each and every episode. And until next time, hasta la vista.
You've just listened to the Invest Florida podcast with Eric Odom and Steven Silverman. Join us every week for actionable real estate investment ideas, and of course, visit our website at www.investfloridashow.com for more shows and tips on how to earn a cash flow in the real estate market in Florida. While hosts and producers of the Invest Florida Show have no reason to doubt the validity of comments of our guests, we do not warranty their accuracy. Please check with your legal, financial, and tax advisors before entering into any investment. Returns will vary from person to person and deal to deal based on unique circumstances. All information expressed in this show is for educational purposes only. Opinions of the guests are not necessarily shared by the hosts and producers of the Invest Florida Show.